welcome to Taking Stock, the show where we take stock of the week gone by and, of course, prepare you for what might be coming up next on Dalal Street. I'm Surbhi Upadhyay, and with me is Prashant Nair. So, Prashant, if we just go by the numbers, then it's not looking as bad, right? Because for the week as a whole, we're still positive. We're better off than some of the other global markets. But
mid-caps. I mean, what's the number for the mid-cap index?
The mid-cap index, exactly. So that's been the biggest, spoil sport or the sore spot for me. Because of the week, we're down 1% on the mid-cap index.
Yeah.
And if you start counting losses from May onwards, then it's 7-8%. For the year, it's 12%. So that problem for the market is persisting. I think that's what this week has told us.
Oh, absolutely. But, it's been a week with lots of global developments as well. That has played its part. And, all in all, it's not a bad week, as Surbhi pointed out. But why don't we sort of wrap up the week and also look ahead. Actually, more than wrap up, which we will do with graphics on the show through the course of the next 30 minutes or so in terms of what happened. Let's look ahead as far as some of the key variables are concerned. So let's begin with, the big one. So this is essentially the dollar. The general views which seems to be emerging is that the dollar was rallying. It was being seen as a corrective rally in a broader downtrend. And now the consensus which seems to be emerging is that rally, that corrective rally up move in a broader downtrend is starting to come to an end. So the dollar index for that matter is also starting to head lower. So that is point number one. And that is, we can say global stuff doesn't matter and doesn't influence. The dollar does matter in terms of emerging markets and emerging market assets. So that is positive, the fact that the corrective rally is coming to a bit of a close. Oil is the other one. It sold off about $3 or $4 or so. And again, there, at least on charts and, technicals, etc., it does seem that there is more to go on the downside, although many aren't ruling a short-term bounce back to the 69-odd range. I'm talking about the WTI prices. As far as the big index, the all-important S&P 500 goes, the view remains pretty constructive. There is no, we see these wild swings once in a while based on what Trump tweets or some other news flow, but generally things have been constructive and positive there. So what does it mean for India? Just looking at these global developments, you've got the dollar, which seems to be topping out, oil, which is selling off a little bit, continues to sell off a little bit. How bad can it get? Not just for stocks, but for the currency as well. The rupee has had it pretty bad recently, but maybe it starts to improve. But what are the worries? And we discussed mid-cap, the fall in the mid-cap index. So that has not abated yet. So people were beholden to this big rally over the last 2 years in the mid-cap side of the market, mid-caps and small caps. Stocks are down 30-40%. But, it's just identify those stocks which are down 30-40% and just go back and see what those stocks have done over the last 2 years, 2.5 years. They're still up 3, 4, 5 times.
Sure.
So that is one point. So maybe is the sell-off over? It doesn't look like that. Politics, will it wane? The way markets rallied on Thursday, the week gone by, it seemed like, the way it rallied, it looked like the BJP won 11 out of 11 bipole seats. Well, it did not. So at some point, will it start to wane? It's a question mark, and no one has the answer. And of course, RBI meeting, right? 4th to 6th. So there is, will the RBI act with interest rates? Some other emerging market central banks have acted. So that again remains an open kind of question. So those are things to watch out for.
Absolutely. So that sets the context. Let's welcome the guest that we have joining us on the show this week. We are with Nilesh Shah, MD of Kotak Mahindra Asset Management. Nilesh, always a pleasure talking to you. Thank you so much for being with us. I'm going to start first with the problem area in the market, and that's mid-caps, because this has been on for a while, in fact, since the budget. First we were told that it's probably because of some profit-taking. Then the talk was that maybe because mutual funds are adjusting their schemes thanks to the SEBI's new requirements, that's causing this churn and some sort of a fall. And then it's now moved on to auditor issues and other market surveillance issues and new margin requirements, etc. What is your prognosis of the way mid-cap stocks are still falling? And specifically this trigger about AMCs adjusting their schemes, the mutual fund buying and selling. Is that still on, or is that completely, at least that reason is completely out of the way?
So the reality is that mid-cap stocks are falling because they were excessively valued. Last year, mid-cap index delivered almost 35% return, small caps delivered 55% return. This year, obviously, there has to be an adjustment. But if I make a simple statement that mid-cap, small caps were expensive and that's why they are falling, it won't look me knowledgeable. So I have to find out other excuses, which is like, oh, mutual funds are adjusting their portfolio and that's why this is happening. Oh, this is happening, that is happening. The reality is that there were many small and mid-cap stocks which had gone ahead of their fundamentals. Now they are coming down towards their fundamentals.
So have they, broadly speaking, I mean, I don't know if you've looked at the P multiple for the mid-cap index. Has it come to more reasonable levels, Nilesh?
No, Prashant, I think there is still some room for downside in small and mid-cap stocks. But again, we'll have to differentiate between quality mid-cap stocks versus hope-driven, greed-driven and momentum-driven mid-cap stocks. Many people give money to portfolio managers and then on side, looking at their portfolio, they build their own portfolio on top of it. Now, many a times managers move out, but those investors are stuck and then they come to sell in the market. Many a time people chase momentum because this stock is going up for last 90 days. It will continue to go further up. Many a time people end up investing looking at how a high net worth individual or a renowned investor is invested without thinking about his capability or without thinking about his ability to take the volatility. So all these things have created problems for momentum-driven, hope-driven, greed-driven mid-cap stocks. And there, I think there is a reasonable amount of downside. But there is also quality mid-cap stocks which have fallen in line with other mid-cap stocks. And those mid-cap stocks over probably next 1 or 2 months will start making a bottom. And that will be good opportunity to build portfolio. But right now the momentum for small and mid-cap stock is negative.
Nilesh, that's the critical question, right? And I know we can't get into individual companies and stocks with you, but what are you telling your fund managers at this point, particularly the managers who are managing mid-cap funds? What sort of themes look safe to you? What kind of pockets would you venture in where you do see value after this fall?
So definitely one message which we have given to our fund managers as well as to our investors, we won't make the same mistake which a retail investor will make. We will invest in businesses after doing appropriate due diligence, and we won't be chasing a stock just because there is a momentum into it. There will be a logic, a rationality, a discipline behind our every investment. There's no guarantee that we will be always right. We will make mistakes, but most of the times we will be right. Today, what I am advising my fund managers is to look at mid-cap stocks on the basis of what market is pricing in terms of growth versus what, in their opinion, these companies will be able to deliver in terms of growth. As long as in our portfolio we have stocks whose growth will be better than what is priced by the market, then we should be safe in a volatile market. The second, obviously, is quality and governance. We want to back those management where minority shareholders are protected and where corporate governance is upheld. If we can focus on so-called quality stocks, I think our downside will be protected. So right now the focus is on governance and growth.
Staying with mid-caps, Nilesh, could you give us a construct for our viewers? How to look at it? I mean, you identified a couple of things which one needs to look at before putting money to work. But any, mathematical construct, for example, what are the most important things to look at in some of these names?
So there are three things to look at in any businesses, whether it's large cap, mid cap or small cap. One is business, second is the management, and third is the valuation. Let me first talk the management part. Essentially, if I can put a thumb rule, and obviously it is a thumb rule, it is not universally applicable, you want to invest in those businesses where managements are mature and yet they have hunger for growth, yet they have hunger for growing their businesses. Second most important thing with management is that they should not take minority shareholders for a ride. They should uphold corporate governance. So as long as we can get hold of a management which will uphold corporate governance, which will protect minority shareholders, which is matured enough through the ups and downs of business cycle, and which has hunger for growth, we will be fine to invest in that company. The second thing is to look at valuation. Now, valuation is art. There's no mathematical construct. Valuation is about relativeness rather than absoluteness. So we try to look at valuation from a different parameter, historical as well as forward-looking. We try to evaluate valuation vis-a-vis market, vis-a-vis internal forecast. In sum and substance, we want to invest in those companies where we believe growth will be higher than what is priced by the market. The third factor, which is most important, is the business. You want to invest in business where companies are generating free cash flow. In order to grow business, they don't require dollops of capital from the shareholders. They have some sort of moat around their businesses. There is less competition. So if we can get businesses which are generating free cash flow, where we can be sure about its predictability, and where we believe they have reasonable moat in terms of lesser competition, then that's a great business to own. So combination of business, management and valuation put together gives you a portfolio which, please remember, since we offer daily redemption, we also have to take care of liquidity. I really cannot invest in an illiquid stock because I have to offer liquidity on a daily basis. So once we build portfolio on business management and valuation, I run through them the filter of liquidity to ensure that I'm able to honor my commitment to investors of daily redemption.
Nilesh, I want to now come to the overall market construct. And quite a few things have happened. There seems to be some sign of stability in oil prices. We've just had the by-elections. We also got the latest GST collections, and that number is better than the average we've seen last few months. How do you sum up the broader market context? Do you see a bigger upside for the remainder of this year at all?
So if I have to summarize very quickly, the upside of the market looks capped because of oil prices. They have remained subdued they have come down a little in last few days, but the future trajectory of oil will impact our market significantly. Second, there is issue related to higher real interest rates and liquidity shortage or liquidity tightness in some portion of economy. 11 out of 21 PSU banks are under PCA, so they are not lending. Rest of the PSU banks are also not as freely lending as before. Interest rates burden is higher on small and medium enterprises, so this is acting as a speed breaker on the growth. And third, and the most important topic which will cast its shadow on the minds of investors, what will be the shape of the government post 2019 general election? These three things are likely to keep our markets upside limited. On the other hand, downside also looks restricted because one, monsoon is good and the economy finally seems to be picking up the momentum. Today we saw the auto numbers. Ashok Leyland sales up 51%, Maruti sales up 26%, Eicher sales up 23%, Bajaj Auto sales up 30%. I mean, this kind of sales growth is unbelievable, and I'm sure what is happening in auto sector will get reflected into steel sector, into battery sector, and so on and so forth. Clearly, the corporate performance is slowly but steadily improving. Most of the managements whom we are meeting today are talking about future with optimism. I met a cement company operating in central India today, and they said, I have no cement left to sold. We are operating near full capacity, and there is so much demand led by rural housing, which is creating this much demand for cement. And I said, I believe rural is under stress, and you are saying that rural housing is having such kind of demand. And he said, there has been almost there's almost 100% increase in procurement of wheat in his area, which has resulted into money in the hands of farmers. And the farm loan waiver also has put money in the hands of farmers. Put two things together, they are seeing a tremendous spurt in rural housing, which is reflecting into cement consumption. So underlying economy is strong, the momentum is picking up, but at the same time, we can't ignore real interest rates and liquidity shortages for some portion of the economy and the political equation which will get formed in 2019. So unless until one of the variable changes, I think market will remain range bound.
What happens if we get a rate hike next week from the RBI?
The rate hike next week is more or less factored in, or more than adequately factored in, if I may dare to add. The April Monetary Policy Committee minutes did indicate about a rate hike. If I see the 10-year yield spread vis-a-vis repo, it's almost 186 basis points. So it's not only discounting potential rate hike on June 6th, but also furthermore, the short-term spread between 90-day CP and repo rate also is almost 160 basis point. So my guess is that market has been more than adequately prepared by RBI in terms of communication to expect a rate hike. Whether that happens in next week on June 6th or it happens later on, market has been adequately prepared for it.
Okay, let's see if the RBI chooses to pleasantly surprise then. Well, Nilesh, always good talking to you. Thank you so much for taking out the time and being with us on the show today. On that note, we have to take a quick break, but before we do that, we will leave you with some more market opinions that we gathered during the course of the week. When we come back, Ashwini Gujral with us to give you a technical perspective on the market.
I think emerging markets have started a stronger cycle, and I think if you want to pinpoint the period it was in, sort of 2016, as you know, ultimately earnings are your sustainable driver of emerging market returns, and earnings reflect, if you like, where you are in a cycle. And of course, after a prolonged period of negative earnings expectations, it plateaued in 2016. It recovered strongly last year in 2017, which incidentally meant that the strong stock market move you had was very well supported, and it's continued in 2018. And I think the key focus for a fundamental manager such as myself is following the earnings progression. Earnings are also notably strong, broad-based across countries and also industry groups. So it points to an overall quite a constructive view on emerging markets.
The sectors that we like today would definitely be the consumption stocks, the QSR companies. I mean, their SSG numbers were phenomenal for the last quarter. I think the other sector that we like, and again, this is you've probably heard this a million times, is the private sector banks, and clearly shying away from the PSUs.
I think the series of higher tops and higher bottoms is likely to continue throughout the rest of this year. And this consolidation that I spoke about is really the foundation of the next big 10% move that is likely to come in on the index. And we expect that to play out, in the next 6 to 8 months. So once we have that breakout beyond 10,700, you will have triggers in place to believe that closer to the end of this year, you could see the Nifty at 11,800 level.
It's difficult to take a very definite call on where markets might go. So if you ask me what's going to happen in 5 years from now, I'm very, very constructive on India. But there is high crude prices, some of which is let off, of course, and oil marketing companies are jumping off their cracks of 30, 40, 50%, or I don't know where they are, right? So you can play it on a day-to-day basis, or you can take a 2, 3, 4 year view out and say, that I really don't care what happens with political uncertainty, what happens with the weak rupee and high crude prices. I will buy what I think works for India in the long run.
Welcome back. You're with us here on Taking Stock. We look back, we look ahead, and we get your opinion, both fundamental and technical. You heard from Nilesh Shah of Kotak Asset Management Company earlier. Let's get in a chartist perspective. Who better than Ashwini Gujral, who's with us right now? As always, Ashwini, thanks very much for being with us. What a week it's been. I mean, your big takeaways for the week that has gone by, what really stood out for you?
Well, for the week, it was volatility created by HDFC Bank. See, overall, you have to see everything in the context of this being a sideways year. So that leads to a sideways month, that leads to a sideways week, and a sideways day. So that way, we've hit the upper end of the range, 10,700, 750. Chances are the ranges will keep shifting up on the upside and downside. On the downside, we won't break 10,200. On upside, we'll make a heavy meal of 10,800, 900. So that way, this volatility, one day it's, Spain, one day it's Italy, one day it's local elections. So this will keep people busy. But what is getting more and more serious is the mid-cap correction, because that will start leading to, maybe withdrawal from mutual funds, retail selling, and overall, a fairly strong blow to sentiment. And if FIIs are not buying and mutual funds tend to slow down, then the obvious support of the market tends to get weakened.
Ashwini, take your point on the mid-cap correction. That's really been the hallmark of this week as well, right? But, there's a general chorus out there. A lot of people saying that perhaps this is a good time to start thinking of value picking, putting mid-caps in your portfolio. Do you agree with that? Are you seeing, any chart trends where perhaps, this is a good buying opportunity, or is there much more pain ahead?
It's always easy to tell other people to hold on to conviction. They're already down 40%. And, the reason that these guys were going up, the mid-cap stocks, was cost of capital. Now, till that shows signs of reversal, I don't think it's a great time to buy mid-caps, because they will not fall because of any sort of fundamental information, just because, their cost of capital goes up. So this year, probably till the election, it's a bad time to do mid-caps. You want to do them, just buy some mid-cap ETF where the average damage is much lower. Because as we've seen, Manpasand, etc., this was a 750 rupee stock. So, what are we talking? And these accidents will happen because valuations are already so high. One mistake and everything starts collapsing on the downside. Yes, you can buy stuff like, Motherson Sumi and, the real blue chip type mid-caps, non-index. But other than that, don't go lower down the rung.
Fair enough. So for the coming week, would you say that the relative outperformance we've seen in large caps so far vis-a-vis mid caps continues?
Well, mid caps will fall, 5, 7, 8%. Large caps may do their 1.5%, 2% type of falls, because it's very obvious we are in a 2010 type of market where 35, 40 stocks, the Nestle's, the HULs, etc., they outperformed, and the rest of the market basically tanked. So it's getting to be a bit of that. So just stay with stocks which are at all-time highs, and that'll keep you safe.
Okay, so Ashwini, let's get down to the trading strategies. Now, what about the Nifty and the Nifty Bank? Are you thinking short? Which way for next week?
Well, if HDFC does not perform as people are expecting, chances are Bank Nifty will give back a lot of its gains, and so will the Nifty. So that way, 10,700, 800, it does not look very likely we are going to sustainably get past that, because today the market breadth was 1,200 to 350, decliners to advancers. You cannot make great headway, when so much of the market is down.
Okay, so for our viewers, what would you advise as trades from here, Ashwini?
See, Canfin Home has again started its decline. So that's a sell with a stop of 370, target of 354. BEML is a sell with a stop of 900, stop of 950, target of 900. Bajaj Auto is a buy with a stop of 2850, target of 3000. And today, yields started to go up again. So financials could come under pressure, because if GDP growth is great, then interest rates are probably not going to get cut. So that will keep the yield and rates higher. So that will again put pressure on PSU banks, etc.
Ashwini, thank you very much for joining us, and appreciate your time here as always. So that's it from the both of us and the team on taking stock. Surbhi's, by the way, been here a week, right? After the holidays.
Yeah, I joined midweek, but there's a fair amount of action.
Planning another one?
I wish, but no, I don't think so. We will be back bright and early on Monday morning. You enjoy your weekend, and thank you for watching.